Hi. My next book, The Advanced Sleuth Investor, should be out next month. It aims to prove to you that some stock information cannot be contained in ink and blips. Intellectuals who learn about life only from books resist the idea. CFAs, chartered financial analysts, are such market intellectuals. For them, the financial statements and perhaps charts are everything. So if you can get the information they are ignorant of, you can take their money. Now, CFAs are not the only intellectuals guilty of such conceit. Scientists are often guilty of it also. For example, physicists assume that the universe's entire behavior can be duplicated by the behavior of ink on paper, also known as math. This, however, is not true. It has been proven. The 2022 Nobel Prize in Physics was given to a trio of scientists who proved that in some areas of the universe there are no variables, that is, no categories, and therefore you can't handle them by math alone. So how can you do forecast, which is what physicists do? In physics, they do it with complicated statistics of probability, called quantum physics. But you surely say, how can this help you take CFA's money? After all, you are not a statistician, nor a physicist. The answer is twofold. First, you can dig for physical information before it became accounting math. But second, you can also use the science of probabilities to your own advantage. Use how? Like champion athletes or chess computers, keep a precise record of all your actions, track what works for you and what doesn't. Then do more of the first and none of the second. Then you'll improve. This, by the way, is also what Charlie Munger, Warren Buffett's partner, recommends as the best strategy of success in life, whether in investing or anything else. And that's also how the latest chess computers like AlphaZero or Leela play chess. They simply play against themselves again and again and keep track of what works and what doesn't. As for why did this specific move help produce a win while another one didn't, the neural net doesn't care. It only cares if it works. And that is also what you can do when you aim to improve your sleuthing. But do it how? You'll have to keep track of everything you do in your investing, everything. Why you thought it a good idea, what were your info sources, and over time, see what was the result of each decision. Write it down. And once every few months, look at it. Over time, for example, you'll see that you suck in mining stocks, like I do, and then do none of them. While biotechs is just your cup of tea, and you'll do more of that. Or the charts always make you lose money, like they do for most people, while talking to company employees, no matter about what, usually leads to better profit. Then, day by day, you'll do more of what worked for you and stop doing what doesn't. In my book, I show the actual case of a young guy from India who came to the US and became the top salesman in a watch store just by copying the moves of other salesmen blindly, keeping what worked for him and ditching what hasn't. Now, why a particular move succeeded while others didn't? He didn't care. Causality is not part of the method. Correlation is. I too have been doing it for years off and on, keeping track of what worked for me and what doesn't, and much more recently. And there are three conclusions I can draw for you. First, don't try to convince others to do what worked for you. It's part of your behavior. Let them do their own and keep track. Second, keep a meticulous record of everything you do in investing, because your really stupid actions, your brain will make you forget unless you write it down. But third and most important, go over your action periodically and the results and draw conclusions in writing. Then yes, do more of what worked and stop doing what hasn't. The second one is the most difficult one. Call it your own private AI. Now, why am I telling you all this? For two obvious reasons. First, because I'd like you to buy my coming book out next month. But second, as a foretaste, here is what my own private AI is telling me about a major part of the market based on its record of what has worked for me before and what hasn't. What it tells me is this: the price of energy in general, and oil in particular, is likely to fall significantly. How significantly? I would say that by past record, about a third or a half. Now, why would it? Isn't the world running out of oil and gas, with Russia's oil exports being blocked and U.S. shale oil being banned by progressives? That's all as may be. All I can tell you is that my own little AI, which is a meticulous past record going back years, points to me facts that were always present before oil plunged. Like what points? Like massive conviction that oil is running out, or a choir of economists urging governments to develop alternatives, and most noticeable, a choir of, shall we say, the less educated that promote this view of scarcity. In other words, the declining educational quality of those promoting the common view. So if all uneducated agree, must it always be the opposite? No, not always. But when most other facts fit, then yes, usually. For example, when I was in Golden Capital in the late 70s and early 80s, Pierre Trudeau, that's just his father, was prime minister. He too believed in oil scarcity. At the time, a leftist think tank called the Club of Rome, the progenitor of the World Economic Forum, forecasted a huge rise in oil commodity prices. So the Canadian government instituted tax benefits that pushed companies to drill the polar ice caps. I kid you not. A company called Dome Petroleum did much of the drilling, and of course it went bust once oil plunged. Now, it was not the only time of resource euphoria. Similar periods repeated later with conviction by the masses that oil price was going to the moon. However, these are just backgrounds for the AI. It also keeps track of chats I had with oil and gas people and the words they use. I'll keep these words confidential. Many of the words fit the present. On top, my private AI keeps a record of some of my preferred valuation numbers, like ratios of price to property, plant, and equipment, and more. All are correlated with subsequent steep price decline. Am I sure? Of course not. Nothing is certain. All I can say is that based on the records of what I call my private AI, oil today is much more likely to fall a lot than rise. But why specifically? The AI can't give me any one precise reason, just as the chess AI cannot tell me why a certain move is best now, just that it is the one most often worked and therefore is most likely to work now. But remember, this is all based on my own preferred data, my own past mistakes, and my own way of looking at things. So it's good for me only. Therefore, it is neither a forecast nor a recommendation. I cite it here with only two aims. First, of course, to whet your appetite to buy my next book next month. But second, to nudge you to do your own deep sleuthing into oil and gas stocks just in case you happen to own any. You know what? Let's go for some accountability here. Oil today is 76.36 US dollars a barrel. That's Western Text Integrated, WTIC, or 82.74 Brent Crude. If my long-term AI is right, these prices should be lower a year from now. So let's revisit the topic a year from now and see if my pet AI got this one right. Hopefully, it will also give you the urge to start developing one of your own. Develop how? Right, next month, buy my book when it comes out and see. Should also help you take the money of CFAs who believe all information is in the financial statements and in charts. That's all for today. Please let me know below what you think of the above. Give it a like and subscribe to the channel and tell all your friends who they subscribe to. I'll see you next time. And meantime, thank you very much for watching.